Recent economic data confirms AI-driven labor displacement is actively occurring. Studies led by researchers like Eric Brynjolfsson show that employment in occupations highly exposed to AI has declined since late 2022, with entry-level roles taking the hardest hit. This displacement triggers a macroeconomic mechanism known as the AI Layoff TRAP. When a firm replaces a worker with AI, it successfully lowers its internal labor costs. However, that laid-off worker immediately stops spending money in the broader economy, destroying aggregate demand across the entire market. This creates a textbook game theory failure. An individual firm keeps all the cost savings from its own layoffs, but it absorbs only a tiny fraction of the resulting demand destruction. Because the damage is socialized across the market, every rival calculates that excessive automation is their dominant strategy. This chart visualizes the overautomation wedge. It measures the mathematical gap between the rational self-interest of competing firms and the collective optimum for the economy. When firms over-automate, total market profit falls. Many analysts assume there is a natural market correction for this. If business owners take their newly minted AI profits and recycle them back into the economy by spending them, aggregate demand recovers. The math shows that as owner spending increases, the over-automation wedge successfully closes, leading many to conclude the trap is avoided. Owner spending does eliminate the nominal efficiency gap, but relying on this self-correction hides a structural flaw that standard economic models have failed to flag. In his 2026 paper, economist Takuma Kimura points out the error in this optimistic view. The standard model tracks nominal dollars, conflating the amount of money in the system with real, physical purchasing power. To measure real economic health, we track the owner real consumption share. Instead of looking at dollar amounts, this metric tracks exactly who gets to consume the physical output generated by the economy. This right side chart shows the owner real consumption share. Kimura's math reveals a paradox. The exact mechanism that corrects the efficiency gap on the left, owner spending, mechanically drives the owner's share of physical consumption toward 100% on the right. This inverse correlation is structural across the entire data range. As efficiency improves through owner spending, equality deteriorates. The two metrics move in opposite directions simultaneously. The economy does not escape the layoff trap. It converts a collective economic loss into systemic inequality. This block represents the sector's physical output constraint. In the short run, integrating AI alters a firm's labor costs, but it does not increase the actual volume of physical goods the sector produces. No matter how much cash floods into this market, the physical ceiling, represented by this block, remains completely static. We measure the influx of that cash using the recycling parameter. This is the fraction of new AI-driven profits that business owners choose to spend back inside this exact sector. As owners spend more, this recycled money pours into the market, expanding aggregate demand. Pumping expanding nominal demand into a system with an unyielding physical output ceiling mathematically guarantees a price level shock. The price level of any market is calculated by dividing total aggregate demand by the total physical output. As owners recycle a larger fraction of their profits, the aggregate demand in the numerator expands continuously. This chart tracks the resulting market data. Worker nominal income is locked flat at 600. But because the physical output in the denominator cannot grow, the price level is forced to absorb the entire impact of the new money, scaling from 71.0 to 195.0. The mathematical consequence for workers is immediate. Their flat nominal wage bill is now divided by a rising price level. When we look at actual goods, the physical units workers are able to consume shrink severely, dropping from 5.92 units down to 2.15. The workers' nominal wages did not drop. Their paychecks look exactly the same, but their real purchasing power has been decimated by inflation. Market self-correction through owner recycling acts as an invisible, regressive tax, transferring purchasing power away from labor. If workers are buying fewer goods, we must look at the owner's side of the ledger to see how their share of physical consumption approaches 100%. This diagram illustrates the Keynesian multiplier applied to owner profits. The money that flows out of the owner's account and into the market operates on a closed loop. Because these individuals own the firms, every dollar they inject into the aggregate economy is ultimately collected by them as new firm revenue. This self-feeding loop balloons their nominal profits. It supplies them with the exact capital required to buy up the physical units of output that the workers can no longer afford. The proposed solution of owner spending is a closed-loop macroeconomic system that mathematically enriches capital at the expense of labor. Kimura's paper also addresses what happens if AI displacement outpaces the broader economy's ability to adapt, a scenario known as the congestion caveat. This depends on the labor reabsorption rate, the fraction of lost wages that displaced workers manage to recover by finding new employment. If mass layoffs congest the labor market, the reabsorption rate drops. This accelerates the uninternalized demand loss for every individual worker. A falling reabsorption rate supercharges the initial distortion. It carves the AI layoff trap exponentially deeper before owner recycling even has a chance to begin. Kimura's findings suggest that AI automation represents two distinct failures happening at once: allocative efficiency and distributional inequality. In economics, Tinbergen's principle dictates that a distinct economic objective requires a distinct policy instrument. You cannot solve two separate margins with one tool. The standard widely proposed policy solution is a Pigouvian automation tax, designed specifically to penalize firms and force the over-automation wedge closed. But the math proves this tax fails the Tinbergen test. As owner recycling naturally rises in the market, the required efficiency tax mathematically falls to zero. The tax corrects the efficiency gap, but leaves the wealth transfer entirely untouched. Relying on an automation tax alone, or waiting for market self-correction, eliminates economic waste while ignoring poverty. This policy matrix maps out the actual interventions required to navigate the AI layoff trap and solve both margins simultaneously. An automation tax lights up only the efficiency axis, leaving the rest of the board dark. Implementing redistribution, like a capital tax transferred directly to workers, lights up only the distribution axis. It must be paired with an automation tax to stabilize the market. But look at worker reabsorption. When placed on the matrix, it lights up both axes simultaneously. Rapidly transitioning workers to new productive roles preserves foundational aggregate demand. It keeps money in the hands of labor, avoiding the price-inflating feedback loop of owner recycling entirely. Structural reintegration of human labor serves as the primary defense against the trap, outperforming isolated taxes or market self-correction.